Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Today, we have Jason Ayres with us. And Jason, of course, spends a lot of his time looking at the charts, looking at the technicals of the market, understanding where risk and reward might lie. Not only does he do that, he understands options very, very well, and he helps investors understand where the risk might be. So Jason has a program, and again, you might want to go to optionsource.net to learn more about how individual traders can join Jason's network and take advantage of Jason's expertise. So please, please, please go to optionsource.net at the end of the presentation and see if his services, their services, are something that you might be interested in. So without further ado, I want to introduce Jason Ayres. Jason, how are you?
Hey, good. Thanks, Steve. Always a pleasure to be a guest with you in these webinars, and thanks everybody for turning out this evening. Obviously, this evening we're going to talk about a little bit about volatility and how we can sort of adapt our strategies based on our observations in market volatility, obviously with a specific focus on the ISE FX options pair values. So one thing that we always want to remember, of course, is that the options market is largely based on the idea of volatility and probabilities in certain movements in the underlying securities. And so it's important for an investor or a trader to be able to sort of understand just the logistics behind market volatility, how that market volatility impacts an options contract, and then from there, how best to take advantage of or mitigate it through what particular strategy. So we'll, without any further ado, we'll get started. As always, we're going to talk about some examples here this evening moving forward, and just want everybody to understand that it's for educational purposes only, and by no means do I want anybody to think that this reflects my or the ISE's views on which way the market is going to go. Just more so designed to give you guys a little bit more of a practical look at how you could put some of these strategies into play. So in starting, I guess, moving forward here, one thing that we always like to do with respect to these sessions is just let everybody know the extent of education that the ISE offers. And those of you that haven't visited their fxoptions.com site yet, it's pretty spectacular. And I'd suggest that if you haven't, clearly, likely in some respects you have because you're here tonight, but some fantastic guests as I've sort of looked down the lines here, as well as great little tools and features that help investors and traders alike sort of understand the logistics of the FX options market and so on and so forth. So spend a little time there, and definitely you'll get certainly a lot more insight into what it is that these markets are all about. Moving forward, we want to talk about, obviously, as I mentioned, adjusting strategies based on volatility. And when we talk about trading and investing in any market using options, there are really two types of volatility that we focus on. The first is historical volatility, and that's really a measurement of how a particular security has been moving or deviating, as the term goes, from its average price. And this is, in fact, a measurable number based on previous, more or less, price action of the security. So we have our historical volatility that sort of gives us a benchmark as to how the underlying security has been moving, whether it's been highly volatile and making big price swings, or whether it's been low volatility, making very sort of narrow price movements. This gives us an idea more or less of what I like to call the personality of the underlying security. In the options market, we have what's known as implied volatility, and I mentioned that that options pricing, for the most part, is I shouldn't say for the most part, but one component of the options pricing is the probability that the underlying security is going to make a move, and to the extent that it is going to make a move, and that pricing variable is known as the implied volatility of the option contract, and it's really a reflection or representation of the market's expectation. So in other words, the underlying security may not be moving. We may not see any price change in the underlying security, whether it's the YUK or the EUI or any one of the other pair values. We may not see a move in the underlying security, but the option contracts pricings may adjust based on an expectation of that move or an expectation of the future volatility of the underlying security. Now, I talked a little bit about the different variables that influence how an option is priced, and there's really sort of a standard set of variables that we look at, and this applies for the most part across the board, whether we're talking about stocks, whether we're talking about currencies, whether we're talking about commodities. There are a certain set of standard variables. So some of the fixed variables that we would look at, or constant variables, if you will, would be the underlying price of the security, the strike price of the option, the time until expiration, of course, interest rates having a greater impact or a great impact on the currency options, dividends, but as you can see here, I've just mentioned that applies to stocks only, and then of course we have the volatility, which is an adjustment for the risk involved in being long or short the security or long or short the options contract. So this volatility, when we look at it a little bit more closely, is, as I mentioned, the adjustment for risk. And as far as the implied volatility goes, it will adjust based on specific market conditions. So when current market conditions are relatively stable, then implied volatility tends to stay within a certain range. But as variables change, such as announcements or mergers in the case of stocks, or when we talk about currencies in the case of sort of various economic or global market conditions, or even increased speculation. So when those conditions change, we see an influence in the implied volatility variable of an options contract. And that implied volatility is really an adjustment for the probabilities in that underlying security moving. So we're talking a lot about probabilities and such because, as I mentioned, this is really, for the most part, how an option contract is going to be priced, or one of the main variables is just based on the probability of that underlying security making a specific move. And what happens is that this measure of probabilities can be viewed in what's known as a probabilities distribution curve. Now, I don't want to get too technical. We want to try to keep things, relative to the average investors or traders sort of experience level. But it's real easy to sort of put this into perspective. When we're looking at a particular security, in this case, we're looking at, say, an underlying security with a value of $50, and you can see here that what we've done is we've illustrated the current market value of this particular security at 50. Now, under normal conditions, or I won't call it normal conditions, but under these conditions that we're looking at right now, you can see that the market maker, who is essentially responsible for pricing the option contracts, they've priced the option contracts such that there is a 68.2% probability that this particular security within the time frame of the option contracts that we would be looking at is going to remain within one standard deviation. Now, standard deviation sounds like a very technical term, but again, it goes back to just the movement of the underlying security and how far that underlying security can move either up or down on any given time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.